Assalamu alaikum wa rahmatullahi wa barakatuh, and welcome back to another episode of the Ummahpreneur podcast. I'm so excited to connect with you guys today for a very special episode. If you don't know who I am, my name is el-asmar. I'm the host of the podcast and the CEO of Ummahpreneur. And today I bring with me Brother Ali Ahmed from WahedX, formerly known as Maidan Capital. Ali, assalamu alaikum wa rahmatullahi wa barakatuh. How are you today?
Walaikum salam, Brother Abi. Alhamdulillah, I'm great. Great to have to be on the podcast with you, and thank you very much for inviting me on.
Of course, the pleasure is all mine. And I'm super excited about this conversation because, to be honest with you, I think the conversation we're about to have today is one that so many Muslims reach out to me. I mean, I think the majority of the DMs that I receive on Instagram is really about how can I get halal funding for my business? How can I, create a business where I can get venture capital and I can grow this idea that I have in my mind. So having someone like yourself that really works within this industry and specializes in this domain is going to be incredibly valuable, inshallah. Can you share with us a little bit more about what it is that you do specifically, and what does WahedX do as well?
Yeah, so great. No, definitely, I'd be really interested and excited to have this conversation because I get the same as well. So it's great to actually have something that will be hopefully resonate with many others. So my role at WahedX is investor relations. And essentially what WahedX is we are a private investment platform. So we serve two purposes. So for investors, it's giving them access to highly vetted Sharia compliant tech startups. And for founders, it's a place to go to raise capital that is Sharia compliant. So traditionally, if you were a founder and you're looking to raise capital, where would you go? You would go to a bank who offers you a loan, which isn't Sharia compliant because of, it's based on interest, or you would go to a venture capital firm who offers preference shares. And Sharia scholars have unanimously agreed that preference shares are not Sharia compliant due to its debt-like characteristics. So you're really left with no real scalable options for raising capital. And if you were to choose to go for preference shares, the chances of success are pretty low. So just in the UK from 2009 to 2019, only 1.7% of venture capital funding went to founders from diverse backgrounds. And from that statistic, we can only work out what percentage actually went to Muslim founders. And that's kind of the whole purpose of WahedX. We want to be able to plug that gap and be the go-to place for Muslim founders globally to come to with their ideas and concepts and startups and go through a process where they can potentially obtain funding at the end of it.
Yeah, definitely, 100%. And what role do you play, Ali, within the organization? What do you specialize in?
So my speciality is on the investor side. So when we have investment opportunities, my role is to speak to investors, discuss the opportunities with them, tell them about the intricacies, understanding the return profiles. But as part of that, I also get very heavily involved in early stage deal origination. Because I have the connection with the investors, I can speak to the deal origination team and really give them, an investor's point of view and angle. Because essentially that's who we're serving at the end of the day. And so I get involved at both the deal origination stage, but generally most of my role is focused on speaking to investors. And these investors range from, family offices, high net worth investors, down to your everyday investors. So the likes of me and you, Abby, and others. So alhamdulillah, it's great because you get so many different perspectives as well on deals.
Well, I really love the fact that you are specialized in that area. So you're really focused in on, if I understand correctly, working with investors to help facilitate the process of investing in Muslim startups and essentially ethical startups, if I understand correctly. Is that right?
Yeah, that's right. So usually, or if not all of our investors are mission-driven, value-driven investors. So they're looking to support Muslim founders or founders from diverse backgrounds that are doing Sharia-compliant businesses. So some of those may be in the fintech space or generally in other areas that are beneficial to society.
Amazing. So I really love that you specialize within that area, because this is who my audience wants to hear from right now. Is they want to know, from an investor's perspective, how do I create a business that is going to not only qualify for halal funding, inshallah, but as well be a successful business that people will continue to want to invest in long term. So I have a lot of questions for you today that I'm excited to share. And one of the big things is, what have you noticed so far throughout your journey in working with investors and being kind of that person that connects both the investor to the startup? What have you noticed that investors are really looking for when it comes to the businesses that they invest in?
Yeah, that's a really great question, Abby. I think our focus is early stage, so that's talking pre-seed to Series A. And at this stage, you're really looking at the founding team and their qualities. So when I speak to investors, a lot of the questions are around like how much time have you spent with the founders? And we like to put the founders in front of the investors as well. We do a webinar for each of our investment opportunities, so they get to see and get a feel for the founders themselves. So a lot of that is, when you're investing at early stage, you're really counting on the team to be able to pull it off. So I would say most definitely that's important. And when you're looking at a team, you're not looking at just an individual. You can have a single founder as a team that's leading the startup, but it's important to have a diverse range of skill sets within that. So a CTO with a tech background, if it's a B2C play, then having a good chief marketing officer, and so on and so on. So the main thing that investors look at is number one, team. Secondly, it's the idea and how big this thing can be. Because when you're investing in private investment opportunities, you're really looking for a substantial return on investment due to the fact that you're giving away liquidity. You can't take your capital out whenever you want. So the size of the market needs to be big enough to excite the investors, and the numbers need to make sense. So it's something that's very simple. It's a problem you're solving large enough to attract a substantial return for investors in the future. And thirdly, I guess ethics. And this is really important nowadays with, not just on the Sharia side, Abby, but also, the climate change that we're going through, all of these other things, ESG. So investors are always asking me about the social impact of whatever startup that we're bringing to market.
Definitely. So you mentioned three things, really: the team that you look at, the idea itself, and as well the ethics that run the entire operation. Now, you mentioned early stage startups. Now, how early stage are we talking here? Can someone come up to you and say, I have this idea for a marketplace, I think it's really cool, but it's really just an idea in their mind and there's no business plan, there's nothing really? Or does it have to be at a certain point where, as you mentioned, like they do need to have the team in place, they need to have some type of structure, some type of proof of concept, right, in what they want to do?
Yeah, so just to give you an example, I'll use an example that we've done. So one of the companies, if the first one we actually did, was a company called Fairnance. They're based in Netherlands, and they are essentially providing Muslims an alternative to interest-based mortgages. And they came to us at a pre-revenue stage, but both the founders are working full-time. They had secured capital from another venture studio called Venture Rock. And although they don't have any revenue, they had a very detailed plan of execution. So we are open to pre-revenue companies, but we do ask that you spend some time to get to a stage where you have built out a roadmap and a plan, and that you have a very clear use of what you're going to do with the funds post-investment. That gives you a great advantage. Just to give you guys some context, we receive maybe 40 to 50 decks, a month. Potentially that number is rising as well. So it is a competitive process. And we have a highly selective system where maybe one or two opportunities will be live in a given month. So to give yourselves the best shot and chance, it's best to come at a stage when you are ready and you have done a lot of the groundwork to get to that stage. But pre-revenue is, as long as the concept is there and you guys have an idea and are ready to hit the ground running, that's not an issue.
Amazing. So you mentioned you receive 40 to 50 decks a month. Out of those, how many do you actually accept?
So out of those that we actually accept, I'd say between 1 to 2. But that's
2 a month. Okay.
Yeah, that's just, and obviously sometimes it takes longer to review an opportunity than it might not be in 1 month that we get through the whole opportunity. It might take a couple of months. But I'd say between 1 to 2, make it all the way through to the platform and get funding.
Okay.
So
I'm gonna challenge you a little bit here on this podcast because I want to make sure I get all the juice out. What is it about those 1 to 2 that you guys, like give the green light to that the other 40, 50 don't have?
So in terms of that, it's more of a, in a nice way to put it, it's more of an art than a science, right? So it depends. They give you that extra level of excitement and feeling, whether that be the team and the founders. And I'm a bit personally, like, I love a founder that can sell. So that's one of the things that I look for. Can they think on the feet when they get asked difficult questions, and they can really come up with a strong answer and make you believe? And because that's a big part of the business, is raising capital. So one of the guys that we've raised for economy, they're now raising at double the valuation just shortly after closing, and he was one that gave me that feeling of excitement when I spoke to him, because he can think in a almost like another dimension. So it's really, you get the founders, they make you buy into the vision and belief. Also, when you have a market that is huge. So for example, the company that we're just raising for now is the company in Pakistan, and Pakistan is the 5th largest population in the world. A growing middle class with now 64% of the population is under the age of 30. So there's huge market opportunities there. We've had startups that have come out of the region, such as Kareem, who got bought out by Uber. Daraz was bought out by Alibaba. So there's a lot of excitement with that region. So when you see an exciting opportunity, that really puts it towards the top of the pile. But really, apart from that, it just depends on the fit. Like, are we a good fit for you guys, as well as, you guys being a good fit for us? Yeah. So I think for those 4 that we've now done, it's really just kind of a marriage between their values, our values, where we are, and it just fits like a jigsaw piece.
When you're investing in a startup, what is it that you're hoping as the investment firm and as the investors that are putting their money forward? What kind of outcome are they hoping for, right? Generally, are you hoping that eventually this goes public? Are you hoping that it gets bought out? What outcome are you looking for with the company?
Yeah, so we're looking at a tangible exit opportunity. So whether that be a private acquisition or an IPO. So that's the key. There has to be an exit opportunity that is tangible. There has to be some sort of roadmap to that. And we do a lot of work on due diligence of that roadmap, even though it can change and it can be iterated along the way. But for sure, it's one of the most important things, if not, like paramount importance, because I've had startups that have come to us and they have no idea how the exit is going to come. This is one of the fundamentals of raising capital. When you're raising investor capital, you need to have a clear exit strategy for the investor, or have an idea of what it will look like.
Definitely, 100%. So you mentioned that you take on some companies that are pre-revenue. I know we're doing this rapid fire. I'm loving this right now. Yeah. So pre-revenue, of course, someone when it comes to raising money, I think a lot of something that people who maybe haven't done this yet don't realize is that raising money means that you are going to give away a share of the company, right, in exchange for that, right? Like, it's not just going to be free money that goes into your bank account. So for a company that is pre-revenue, how do you determine a fair valuation, right? For an entrepreneur listening to this, how can they determine a fair valuation for a company that hasn't generated any revenue?
So this is a really good question. So depending on, you have to price it based on the market as well. So startup valuations are subjective as well, especially when you don't have anything, you don't have EBITDA, you don't have these metrics that you can use that, more established companies will have. So a lot of the time it's looking at the market and looking at similar startup data. And it's very easy to get data online, by the way. Just go on Crunchbase, PitchBook, and look at similar startups in your sector, look at them from different sectors of the regions of the world, and really map out why you are going for this value. At early stages, you're going to give away more of the business, and that's normal. So one of the approaches that I would recommend, or I do recommend, is raising a lower amount of capital to begin with, so you hold on to more shares, more ownership of your company. And as you get to further stages, raise more capital. Then obviously it's a bit more burdensome than raising in one hit, but at least that way you protect the ownership of the company.
Now, when you're giving away ownership of a company as a startup owner and CEO, does that also mean that you're giving away decision making, or can you give away necessarily shares that aren't voting shares, right, to investors?
That's a really good question. You can essentially give away shares without giving away ownership, or giving away decision-making power. So, for example, on a case-by-case basis, sometimes we take an observer board position versus having board, decision-making power. Yeah. And it's worth a conversation. Yeah. If you have a frank conversation and you point out the reasons why you would want to keep decision-making power, if you've got the right partner in place, they will be receptive and understanding of that. But then you may want to listen to their perspective as well. Or like, why would WahedX want to have a board seat? Is there any strategic reason for that? Maybe it's to guide you guys and help you make the right decisions and for the interest of you and your investors. So really have a good think about that. And one of the things that I would suggest, and which I do suggest, is to actually speak to advisors, speak to others that know the industry, and also founders that have been in the same position that you have. You'll find that through LinkedIn is amazing. You can reach out to founders from literally any company in the world and send them a message. And you'll realize that a lot of them, as you're in the same situation that they are in, they will be very receptive to help. Like, I've done it myself. I've used LinkedIn just to message people and say, hey, like, I'm struggling with this right now. Like, can you give me some of your advice, or what do you think about this? And alhamdulillah, 9 times out of 10, I've had responses. And it's just about putting yourself out there and getting the right people around you to help you make those types of decisions.
I have a question for you in regards to that, in the same kind of from within the same category, and it's something I'm curious about. As an investor looking at a potential startup, if someone comes up to you and says this very thing, which is, I do want to bring you guys on. We need some venture capital to fund the launch of this business, but I actually want to make sure that I retain all decision-making power. For you, is that something that gives you pause as an investor? Is that like an extra thing you have to think about? Generally, would you prefer to have input when investing in a startup?
Personally, I prefer to have input. So generally, we meet with all of our startups once, at least monthly. We just did a workshop with one of them on last week, and we spent the full day together. So we know the value that we bring. Being WahedX, part of the Wahed group that now has 300,000 customers globally, operational in the UK, US, Malaysia, and alhamdulillah, a great tech ecosystem. So we like to work closely with founders. Decision-making power is something that I'm probably not too bothered about, but it's just, I guess, the tone of the conversation, or how it plays out. It plays a big difference. So there's no objection to it. It has to make commercial sense. But generally, it's understanding the partner that you're working with. So if you're choosing to work with us and you want to hold on to this decision-making power, that's fine. But we will give you our suggestions and thoughts and work with you along the way. So you get the best of both worlds.
And the reason I'm asking this is because I actually personally think if you are going to bring an investor to help launch and fund your business, it should not only be that they only bring money to the table, because to be completely honest and speaking from experience, money is actually not that hard to come by as a business owner, as long as you have a validated product and you have product market fit, which once you get that, you can generate an income in your business and it's no problem. But what is actually hard to come by is the right guidance from people who are, in various other industries that have more experience than you, that can help mentor you and guide you towards success. And I think that is what you should look for as an entrepreneur and as a startup owner, is how can I bring the people on board that are going to be strategic partners to my growth, versus how can I just get the money that I need to launch this business? Would you agree?
I definitely agree with you. It's so important to be careful about who you have on your cap table, especially you mentioned right guidance. So if you've got a Sharia compliant business, and let's say you have an alcohol company or an arms company that is offering you capital, like, is it wise to take that? Are they going to give you the right guidance? Are they going to support you, or are they just going to, milk you? So, it's when you're thinking about raising capital, as you mentioned, it's if you've got a good idea and good concept, everyone will come to you. So it's about selecting the right partners that are aligned with you on your values. And I'm in full agreement with you that right now, especially from an investor's point of view, we don't want to just provide capital. We want to give you support. And alhamdulillah, I have like a number of investors that message me almost every day about previous investments and say, hey, like, I have this person I can introduce to them, or these guys have offered to help. And you get a lot of benefit from that, from selecting the right investors, versus if you're just selecting capital just to get quick money in. They might give you the money in a week or two, but they're not going to give you any support after that. Is that really going to help you in the long term? So it's like short term versus long term success, basically.
100%. Now, I do want to ask, and this is something that I'm personally curious about. Would you, as an investor, would you invest in a startup that doesn't have a validated profit model, that comes to you and says, look, we have this really amazing app idea or business idea or platform that we want to build, and it's going to cater to this audience, and this is how we're going to engage the users, and we know they're going to love it, and it's going to be free for them to access, because that we want to essentially attract the audience initially, right? But we don't yet know how we're going to monetize, but we just know that the audience wants this, and we know that we can attract them with this product. So if someone comes up to you in a situation like this where there isn't yet a profit model, but they have a strategy to attract the audience that they feel, we can appeal to the audience in a certain way, is that something that gives you pause as an investor, or do you feel like what we're looking for is bringing on the audience first, and then the profit model can come later? Because I've noticed in Silicon Valley and in a lot of these tech startups, the profit model comes later. So for you as investors, do you want to know ahead of time, how are we going to monetize this, or is that not as important initially?
So for me, I'll speak from a personal point of view. Before I do that, I will just mention that investing in startups is risky. Yeah. And it's you should only really invest if you understand the risks. And if you are considering investing, seek advice from a financial professional. Mm-hmm. From my personal point of view, I have a higher risk tolerance, so I would this would be something that I would be pretty excited about. When you're looking at startups, you're looking at disruptive industries, things that are new and innovative. And if you look at some of the successful social media players, like Facebook, etc., they had no monetization strategy, but they built a large community. So there's value in building communities, and there's value in data. Obviously, we have to be ethical with how we deal with data, but there's value in building communities and solving problems at large scale. From a more conservative perspective, the market has shifted to where it was 12 months ago. We're entering into a global recession. We're having high interest rate environment. Public markets are struggling. So now there's a bit more of a focus on path to profitability and being cash positive. So for this current market, I would say that from a holistic point of view, have that in mind. Like have a strategy in mind for how you will monetize, because we have seen a couple of strong opportunities throughout the year which had essentially that they were building a community, but they didn't have a clear monetization strategy, and they weren't successful through the process. And that's been the case for the whole industry. That I'm looking at startups that are getting funding, and those are ones that are struggling a little more than if it was a year ago. So personal opinion is I like this kind of stuff. That's building communities. But for now, have a focus on being cash positive, getting your path to profitability, and just have a blueprint of what you want to follow for the next, let's say, 3 to 5 years.
Mm-hmm. So what have you seen in your experience to be the best way? And this is kind of giving advice to startup owners, CEOs, entrepreneurs. What have you seen to be the best way, or at least the most common way, for an owner that wants to bring shareholders or bring investors on board to structure kind of like the share agreement, right? So for example, I mean, that's a big question that I get, and a lot of people think about, right? Is like, okay, how much do I really want to give away? And even when I do, like, how am I going to really ensure that this partner is going to be here for the long term? And even not just as investors, but you mentioned building a team in a previous answer, right? Yeah. And for a lot of people initially, as we're even just talking about right now, sometimes we're pre-profit model, pre-revenue in the business. And at that point, it's like, okay, look, I want to bring you on. I think you're an amazing, let's say, developer, but I can't really pay you a salary right now. I mean, I potentially could once we bring people on, but at this moment, I mean, you're betting on this to work with me. So I'm going to have to give you probably an equity stake in the business. What have you seen to be commonly kind of the best way to divvy that up? And I know that's a very, very case by case kind of question, but I don't know if you just had any general advice for our listeners about that.
So for employees, you have the ESOPs, so employee share options. And that's a great way to incentivize people to work in startups, because you give them shares of the business. And I've seen that across all of the startups, more or less all of them, they all have ESOPs. So that's a great way to incentivize your team. But really, you should find a team that really wants to solve the problem. And I guarantee, or can't guarantee, but I'm very, very bullish on the fact that you have a lot of people in today's age that would want to work for a startup and solve a problem that they will be obsessed with, due to the fact that there's so much excitement with it. You're building something from the ground up. You learn so much. There's so many skills that you learn from being in the weeds at a startup. So to motivate them, it's really the problem number one, and how working together on a problem collectively. And ESOPs is a great way. In terms of structures, did you mean in terms of investing structures? So safe agreements, is that what you were kind of hinting at as well?
Correct. Or? Yes, correct.
So if you're early stage, then almost everyone that I'm speaking to that's early stage is using safe agreements. And the benefit of that is that you don't have the long 100-page share purchase agreements that you have to sign with investors. It just saves all of that legal burden. It's a lot more easier to execute. So that would be my suggestion.
What is that? What is a safe agreement?
The safe agreement, essentially, let's say you raise via a safe now. You don't give away equity in your company now. So the benefit of that is when you give away equity, you have like a long share purchase agreement. There's so many terms and conditions. You have to get that reviewed by lawyers. Usually the investor will want to review that themselves. So it just takes a lot longer to execute. Versus a safe is a much shorter legal document, and it's pretty much standardized. I think Y Combinator, they came up with they originated the safe agreement, and it's been used by startups globally since then. And essentially, yeah, it just makes it a lot easier to execute. And then what you'll do is, if you raise that a safe now at, let's say, a capped valuation, when you have a priced round in the future, let's say your Series A, the shares will convert at that capped price at that future round. So you incentivize the investor, because they're in a future round, they're going to get a lot more value for the shares that they have on paper anyway.
Thank you for sharing that. Now, what are some industries that you've seen across the board venture capital firms prioritize when it comes to investment, right? Every single era has kind of like the next big thing that's coming along, right? Like if you rewind back to early 2000s, it was all about like the .com era, right? And like all the tech startups. And right now, I think it's starting to kind of go back to that, but in regards to cryptocurrency, in regards to blockchain, fintech, those are some really, really hot industries right now. But what are some industries that you've been looking at, WahedX and other investment firms, you've noticed that they've been prioritizing when it comes to funding?
Yeah. So it's funny, a few months ago, it was all Web3, blockchain, all of that sort of stuff. Now it's back to AI. So AI is really hot right now. We actually did an AI deal in Q2. So we were a bit ahead of the curve. And we have a specific focus on Islamic fintech. So 2 out of the 4 investments we've done to date have been Islamic fintech. The reason being because our ethos is to look at alternatives to interest-based financing and taking people out of riba. So that's one of our key focus. But generally for VCs, they all have their own angles. You'll have deep tech VCs, you'll have Web3 VCs, and right now, I guess AI is back as the buzzword.
Interesting. What do you think has caused cryptocurrency to kind of slowly wean out of the picture? I mean, possibly, we could potentially relate it to just the large downturn that has happened recently in regards to just the valuation of the market as a whole, but it could be something else as well. What has been your perspective?
So honestly, I don't have too much expertise in the crypto space, but just from a market analysis point of view, it's just generally just the market trend has shifted away. There's been a few big crypto players that have devalued almost to zero, right? So that's had a huge impact on investors and investor sentiment. So that kind of feeds into the decision makers making the decisions that the VCs make. So VCs, the general partners, they kind of feed off of what the LPs, how they react. And a lot of people have been burnt by crypto. So it's generally the market shift, and things happen in trends. And when things happen, they usually move quite a lot, basically.
Yeah. And let me ask you this. What's your opinion on, recently I've been reading in the news that essentially Meta and Facebook in general, it's called Meta now, have been just essentially bleeding money for the last few quarters. I think the last time I checked, they reported like 800 billion in losses, but I could be wrong. I might be off in number, but I know it was in the high billions in terms of not losses, but I think they lost market cap. Sorry. That they lost in market cap. So, you know, they had this big vision for building this entire metaverse, and this vision that they had isn't right now, at least coming to life the way that they envisioned it. So has that also affected, seeing what happened to Meta right now, has that also potentially affected your opinion on cryptocurrency in that market as a whole, or do you think it plays a role?
I'm not too sure. So what's happened with Meta and the other big tech players is generally, look, you've seen a fall in, this is public markets. Mm-hmm. So public markets have lost a lot of value, and you know, capital is there's more investors that are choosing to sit out, or you know, there's less activity. So the impact it has on startups is there's lower valuations for startups, which is a good thing for investors, because we're getting more value now than we were previously, and then much higher potential for return. So I can comment on that aspect of it.
Yeah, please go ahead.
It's definitely a good thing from an investor's point of view. From a founder's point of view, it means that they're giving up more of their company, but it means that you're getting it's a much more prudent environment, and these are the types of environments that you can really thrive in. It's a good time to be a startup at initiation, because you can build your startup in a tough economic climate. So when you have the rosier times, you're already built for it. You're built for tough times. And when you have strong, bullish markets, you'll hopefully reap the rewards of that. But then what it means is when times are tough, you can withstand the winds and the waves and everything.
You know, talking about investors, you know, because I think so far in the conversation, we've kind of left them out of the picture. So it's time to bring them in. Speaking to investors specifically, one of the questions that I had for you is, we talked earlier in the episode about, you know, the fact that what we're looking for is really having some type of outcome related to the investment, right? Is there going to be an exit on the roadmap? Is it going to be bought out? Is there going to be an IPO? So that generally happens only to a small percentage of companies that are actually funded, right? Now, I've always had this question myself. As a venture capital firm, you're putting, you know, so much money into these startups, right? Millions of dollars. Does the money that you invest and then hoping for like that small percentage to actually achieve that outcome, does that outcome, when achieved for that small percentage, make up for all the ones that didn't, right? From an investment point of view.
Yeah, so that's a really good question as well. So from generally, I can speak about the VC market. So top quartile VCs, they have an IRR of 37%. So generally what that means is on an annual basis, you would make 37% cumulative over the course of the investment cycle.
And that's per year, just to clarify?
37% per year, yeah. So 37%, that's the top. That's you're talking about the Sequoias of this world.
Right.
Then you have your average, I think Sequoia might be even higher, actually. I don't want them to come after me. So then you have your average venture capital performance, which is 25% IRRs. So that's 25% per year. And low performing bottom quartile have 12% IRRs. So that's generally the horizon. So most, if not all, you know, good VCs will make their money back. And generally the way they do that is they make sure their portfolios are diversified. So they wouldn't have concentration in one section. They will diversify across a range of portfolios. They may have a specific fund mandate, like deep tech, for example, but they'll construct the portfolios in a very professional manner. What we do at WahedX is we operate on a deal by deal basis, and our minimum investment's £1,000. So the types of deals that we get access to, the minimum investment for angel investors would be 100,000 plus. What we're able to do is, because we're taking an allocation and we have a relationship with the founders which we develop, we can get our investors in from us as low as £1,000. And we generally, when speaking to investors, we let them know that there's multiple investment opportunities available. So it may be in their best interest to diversify rather than, you know, investing any spare capital that they have into one startup.
Speaking of Wahed Invest, so if someone were to come to you to invest in startups, you know, they're listening to this potential ROI and they're like, that sounds a little bit better than the stock market. Let me see what I can do here. And they want to move forward. Now, you mentioned a very good point that you would advise them to diversify for that very reason, is that you want to make sure that they have enough in their portfolio where they can achieve that ROI. Now, if someone comes to you with a small amount, like £1,000, are you going to yourself say, we're going to add this to a fund where it's already diversified for you and you're just going to get the average ROI from that fund total? Or do you ask them specifically, hey, do you want to dedicate this towards one specific startup? How does it work?
So in that case, we would most likely tell them it's probably not suitable for them if they only have £1,000 in capital. You know, there's other, so Wahed Invest allows investors to invest from as little as £100, and that gives you access to a diversified portfolio into, you know, hundreds of stocks, gold, sukuk, and you can liquidate that whenever you want. So you can, that's liquid. So these private investments, even for the most sophisticated investors, it shouldn't make up the 100% of their investment portfolio. They should only really allocate a specific section of it due to the characteristics of the liquidity, time horizons. We're talking about a 10-year time horizon realistically for a portfolio. That's what most funds operate, 8 to 10 years. Okay. So it's a different investment product. So for investors that are looking to invest from as little as £1,000, we'd still say, look, have about, I'd say, 10,000 in savings, and then from there you can create a portfolio over a couple of years. That's a place to start, in my opinion. But everyone's different. That's generally the approach that I provide to friends and family and others who ask about investing when they're looking to get started.
So let's say someone has a bit of a higher amount. Let's say someone's listening to this and like, all right, I got 100K I want to put towards this, because, you know, as Muslims, we're limited in the amount of halal options that we have to generate an ROI. So I believe in what you guys are doing. Love WahedX. I want to move forward with this. Again, my question is, would they be kind of putting that money towards, and my question, the reason I'm asking this is because did you structure, and this is where I'm coming at, is did you structure the WahedX in the way that you fund those startups, right? Did you structure it in a way where you've packaged all of those investments, let's say, right? Like, quote unquote, you've packaged them, like think of like an ETF, right? Exactly. Like you've packaged them into an ETF, and you're like, this is our, you know, halal startup ETF, and you put money towards this, and then, you know, as like some of these startups go on to, you know, achieve their outcome, exits, etc., that ETF grows in value, and over time your investment grows in value? Or is it like, no, it's really going to be like, you know, that 100K, there's like these 10 startups that we're currently looking at, pick one, and we're gonna go for it?
Yeah, exactly. So right now we're on the second model. So we don't operate as a fund, we operate on a deal by deal basis. Okay. So throughout the course of a year, we'll have, let's say, 12 to 20 startups that are available, and it's at the discretion of the investor if they choose to invest or not. And it's essentially not operating as a fund as of now. So inshallah, in the future, we're able to offer more diversified opportunities. Okay. What the fund does give you is it gives you like autonomy in terms of decision making. You choose what you want to invest in, and there's plenty of options there for investors.
So you would actually come in and really you yourself would be a venture capital investor, and you'd have that kind of autonomy to say, well, okay, here's a list of startups that WahedX is currently working with or evaluating, and you can kind of say, well, these are the ones that I want to invest in, and these are the ones that have the most, like, that I personally relate to, for example. Yeah,
exactly, Abi, and that's the whole beauty of it. So sometimes I'll have investors that'll say, hey, like this one's that makes sense to me. I might not invest in this one, but then I'll have another one say, yeah, that makes a lot more sense. This is my area. This is my space. Like I get education, I get ed tech. Like I know there's a space for this, and then they'll go for the one that makes more sense to them. And then other investors will just have a approach where they just want to diversify, so they'll just put their, you know, eggs in different baskets essentially.
How much involvement can an investor who's investing a larger amount of capital have within the startup that they're investing in? How much involvement generally are they able to have when moving forward with WahedX?
Yeah. So from our point of view, we take all of that burden away from investors. Okay. So we do all of the post-investment monitoring, support, opening up doors for them, and really it should be a zero effort on their end. If they do have some strategic value that they want to provide, they can reach out to me and we can provide that. But also from the startup's point of view, they don't need to deal with 200 investors or even 5 investors. They have WahedX, and we're trying to all the capital through ourselves. So instead of having 5 meetings a month with 5 different investors, they have 1 meeting with us, and we cover everything we need to cover and give them the support they need. So it works out better on both sides from that point of view. But regardless if you're investing £1,000, £100,000, the fee is the same. If you might be investing £1,000, but you have strategic value that you can play, investors reach out to me, and they will provide me with that, and I'll channel it to the founders. Part of our whole process is democratizing finance, democratizing access, and part of that is treating everyone at a level playing field.
What kind of, if someone's listening to this and they have a large amount of capital that they're looking to diversify, what have you seen personally to be the type of profile, right, that generally comes to WahedX to say, I want to invest in startups, so that in case someone's listening to this that fits that profile, might be like, all right, I'm there, I think that's the right move for me?
So generally, to be honest, it's people from all walks of life. So recently I've spoken to a lot of doctors, dentists, pharmacists, mashallah, people from the medical profession. You have engineers, accountants, auditors, lawyers, mashallah. And really because this is like our generation of, even our generation plus as well, of working professionals and up middle class, and we don't have access to investment opportunities. The only thing we may have access to is real estate. And real estate is generally to invest in it. It's there are issues with Sharia compliance at times. So this really, it's your everyday working professional that I'm speaking to a lot nowadays. And then on top of that, you have investors that are more experienced. There would be business owners, people that landlords that own houses, restaurant owners. And then you have family offices. So this is capital that some of these families are, their net worths in the hundreds of millions plus, and it's really to cater to everyone, because what we offer is Sharia compliant investing, growing a Muslim ecosystem. These values are universal to investors, regardless if they're just getting started with their career, or if they've they're retired and they're they're part of family office. So really it's people from all walks of life.
Thank you for sharing that. So if we were to wrap up this episode with just a little bit of advice for our entrepreneurs that are listening to this, that are looking to get funding, is there any tips that you can give them, maybe 2 or 3 tips for startup owners that are looking to potentially seek funding?
So first tip I would say is speak to people. So reach out to founders that have raised capital before. Reach out to advisors, build a network for yourself of advisors that can really support you and help you. You will find that there will be a lot of people out there that can do that, and be open to feedback. So a lot of the time, some of these guys that have been through the process will be able to give you gems that you wouldn't get if you tried to do the process yourself. Be conscious of the partners that you take on board. So as Abby mentioned earlier, it's not about just the capital that you raise, it's who you raise it from. So have a good think about the values of the investor, and ask them, like, what have you invested in previously? Like, what sort of support can you give me? And those type of questions make a big difference, and actually it puts you up quite a bit in terms of the estimation from the investor's point of view, because not many people actually ask those types of questions. So don't be afraid to challenge the investors as well. And lastly, do your homework. So know the market inside out, know your problem inside out, spend some time really being an expert of your space. So literally you have to live and breathe it, to the point that when you're having conversations, you can reel off bits of statistics or information, and you just know that you genuinely know and care about the idea. Because being a founder is not as glamorous as it seems. There's a lot of lonely moments. When I'm speaking to founders, you can tell that some of them are tired and exhausted, and it's really a long game. So you really need to be obsessed with the problem, obsessed with solving it, have the right people around you to be able to help you. And inshallah, you can be successful. This is what we want to see. WahedX, Ummahpreneurs, we want to really create the next generation of Muslim founders that are successful. We want to create the next generation of Muslim founded companies that are on the edge of innovation, that are really providing jobs and like amazing products for the Ummah and beyond as well.
Inshallah, 100%. Thank you so much for sharing all this with me, Brother Ali. This was an amazing episode. I think, for me, this is probably one of my favorites because I think we condensed everything that people need to know, Muslims need to know when it comes to, what are the ins and outs of getting halal funding for my startup, as well as potential Muslim investors. What should I know about investing in startups and how can I get started with that? So someone listening to this who wants to work with WahedX, inshallah, where can we tell them to go? Where should they go, inshallah?
Perfect. No, thanks, Abi. Honestly, this has been my favorite episode as well.
Awesome.
So yeah, and to reach me, you can reach me on LinkedIn. So Ali Ahmed on LinkedIn. To reach WahedX, it's WahedX.com, and I'm open for founders, entrepreneurs, anyone to email me on ali.ahmed@wahedx.com.
Awesome.
So those are the 3 ways that they can get in touch.
Amazing. So if you're listening to the episode, make sure to please go ahead and navigate to wahedx.com. If you are a startup owner looking for funding, inshallah, to reach out there. And if you are an investor looking to invest in Muslim startups, go ahead and reach out there as well. And you can connect with Ali Ahmed on LinkedIn. We'll drop his links as well as his email in the description, inshallah. Ali, jazakallahu khairan. Thank you so much for joining me on this podcast. I absolutely enjoyed our conversation and I thank you for your time.
Thanks, Abi, inshallah. Thanks a lot for your time as well. Inshallah, see you soon.
Inshallah, jazakallah khair. And you guys know the drill. This episode and this podcast in general is not sponsored. The way that we actually, and the reason why we do this is really just to give you value and contribute back to the ummah. So if you want to help support back Ummahpreneur in this podcast, go ahead and subscribe. Go ahead and rate and review the podcast and share it with the people that you know. Spread it on social media, Instagram, Facebook, wherever you are. And we'll see you in the next episode. Assalamu alaikum wa rahmatullahi wa barakatuh.